Welcome everyone to the second episode of Future Finance hosted by the Big Whale. We are the leading digital asset intelligence provider in Europe, and we are fully independent, fully B2B. My name is Aleksandar. I'm a lead research analyst and the host of the show. And today I'm very thrilled to host this episode for two reasons. Number one is that I'm a huge fan of DeFi. Second thing is that I wanted to do a show specifically dedicated to this topic through, of course, institutional lens. But I think the recent hacks and the recent exploits that happen and, the developments in the field are making this topic very, very interesting and very, very timely at this moment. I'm joined today by two absolute heavy hitters in the DeFi space coming from two different vantage points. We have Amy, head of digital assets at Morgan Stanley, and Paul, CEO of Morpho, one of the largest DeFi protocols on planet Earth. Folks, welcome to the show. Before we start with our discussion, I want to remind everyone in the public chat to ask questions. And as we progress, I'll direct questions to our guests that will provide you the answers. Now, before we start with the typical agenda, some news, or let's say tweet popped up last night, and it was about how AI could actually hypothetically hurt DeFi rather than fully. We know that it's complementary, but is there any vector of attack here? Manuel, I think he's a founder of Open Zeppelin, argued that coding agents possess superhuman abilities to find code vulnerabilities, and that grants attackers asymmetric advantage to exploit DeFi protocols. Folks, I want to know your hot takes here. So, because Paul, you are the CEO of Morpho, I want to hear your take first. And you were what's very interesting. You were at the Big Whale. You gave an interview to the Big Whale where you said that AI folks are more bullish on crypto rather than crypto folks on themselves. So I want to hear your hot takes on this. Is there any substance, or it's all a bunch of nonsense?
Yeah. So I guess a few takes on like security and AI in general. I guess the first important thing to realize is, the superpower and the curse of blockchain and crypto is the openness and composability, right? And so when all the code is composable, it's obviously has tremendous like upside when it comes to like financial infrastructure, connectivity, liquidity in general. But the downside of that is that your exposure can quickly, multiply to like a very wide range of smart contracts, of dependencies, etc. And there is like this like fundamental trade-off between how composable and how fast money can flow between like different infrastructures, different pieces of code, and how dependent you are on all of those pieces of code. Add to that the openness, which makes it available for anyone to audit and potentially hack. Well, you end up in a situation where all of a sudden, now that attackers are empowered by AI, they are they have the ability to attack any protocol based on like the dependencies that they may have, which is oftentimes very large. So that's like a very strong argument against like in favor of AI, like breaking like DeFi and crypto in general. The good news is that we have very strong solutions, and I think at the end of the day, security is about like the economic power that you have on one end, either the attacker or the defender, and turns out AI made it extremely cheap and extremely accessible to attack people. But the good news is that we also have, thanks to AI, a much stronger ability to defend ourselves. And so what is the defense against AI hackers in this context? Well, it's two words. It's formal verification. And formal verification is extremely, extremely powerful because it mathematically proves, according to a given specification, that the code is unbreakable, right? Like literally. And until AI breaks math, in which case, we have much bigger problems than, DeFi in general. But the general idea is that formal verification lets you, for a given set of specification, be 100% sure, whatever is the economic power of the attacker or the intelligence of the attacker, that your code is going to be safe. And, at Morpho, this is something we've approached way long before AI was a thing for a completely different reason. Is that Morpho, we build like immutable protocols. It's protocols that are going to remain there forever. And so what does that mean? It means that if there's a probability of those getting hacked, they will be hacked, right? Because you integrate the probability that of this risk over an infinite period of time, right? So we, before AI, were already in the mindset that we need to play along this, this infinite sort of like force, which is basically in that case was like integrating risk over infinite period of time. And so this is why like we have like a few coding principles, which is like the code has to be extremely simple and very easy to formally verify, right? And so like Morpho's code is famously extremely small. It's like 600 lines of code. Like, you can like literally read it in like, less than a minute. And most importantly, we have a team of like 3 PhD in like formal verification that just do that at Morpho, right? And the good news is AI makes it extremely easy to do formal verification. And formal verification was a pain in the ass, and it still is, but like AI makes it much easier to actually prove stuff about your code, right? Which
That's
actually
super
strengthens your
interesting,
code in a way that is extremely strong. So to me, it's like a balance. Is like as developers like need to adapt, like they, there's obviously like the guardrail set of things. We need to have like, fire breaks and everything in codes. But most importantly, I think there's like some patterns in coding are just going to become obsolete. Like the pattern where you can like just ship on chain in a public way and iterate on your code base like all the time and upgrade your code, etc. I mean, to me, that's just not going to happen, right? Like you have to take the time, and it's long and painful. Like we ship a protocol every 2 years and we're a startup, right? So it's like extremely long for 600 lines of code. But this is the process that you need to be like, AI resistant kind of
AI
in this era.
resistant. Yeah.
So that's like kind of my take.
And you can use AI to fight AI. It's like fighting fire with fire. Yeah. Amy, does this apply to traditional systems outside of DeFi?
Yeah,
Are there more at risk?
yeah, I agree with a lot of what Paul said, and I think the interesting thing about these posts that come out, this is a new market, and every time we see a new market entrant that looks like it's potentially a threat to existing markets, you have people that want to find reasons that it will not survive. So it's like first it was quantum, and we've been fighting the quantum debate forever, and now it's AI, and everyone's saying AI will have this major impact. And some of that message is true. I mean, look, we're going through this with Mythos right now. We have AI tools that are allowing us to find shortcomings and bugs in the system that are just too much for the bandwidth that our technology teams have to do. So it's making us more efficient. And I think you're dealing with a startup community that's building for speed, and then also having to reinforce that security. So I agree with your you fight AI with AI. I think it'll make the environment stronger going forward. But right now we're just in this like crazy period of like confirmation bias. People that don't want DeFi to grow and exist, they see the hacks that we've had year to date. They say, this is exactly what I'm talking about. This will never work. And, they're just reinforcing their whole narrative that they have in their head that they believe. But there's much more to the story, and people will, the industry will continue to grow and get stronger and understand what the weaknesses are, and we'll have stronger products going forward. So, it's just a cycle that we're in right now.
All right. Interesting that you mentioned hacks. And that's my follow-up question. So we seen in April was a very bad month for DeFi. We had several major hacks in a row. So starting with Drift, coming to Kelp DAO, that was the largest hack, and the DeFi actually took a pretty decent hit. I'm going to just show you a graph on our website. So it was the peak was in April was around 100 billion. Now it's around 82 billion. So pretty much it took 18 billion hit. Did these hacks make you from the Morgan Stanley standpoint and institutional risk assessment standpoint, did these hacks made you pull a handbrake on the DeFi, or did it accelerate like the development of proper risk frameworks?
No, it didn't pull the plug. I mean, I would also ask the question, and I think Paul can talk about this too, but how much was technology and how much was human error, which continues to be the issue.
Yeah.
a lot
Yeah.
of times it's not the technology that's the issue. It's the challenges, and that's what we see. I mean, that's a traditional finance problem that we see all the time. A lot of times it's not the security. We have incredible security teams uh, and infrastructure that we support at the organization, but a lot of if we have any infiltration, a lot of times it is, it's the humans that end up still having, it's like classic email spam, spoofs and things
Hmm.
like that. So,
Social
I think
engineering. Yeah.
we have to figure out like how to manage that. And again, this kind of goes back to my earlier point of like people just want a reason to say why it won't work.
Hmm.
But here a lot of it's like the social engineering aspects of it
Hmm.
too. I think the thing that's interesting is how I've been interested to watch how much of a geopolitical dynamic is woven in here. It's not just innovation in tech, it's become this like state actor area of focus too. So that's actually a little bit worrisome because that's a hard arena for startups to try to navigate because it's like you're going into the Premier League, the D1 sports, and you have no ability to maneuver and have any errors, and that's a lot to manage. I'm sure Paul has thoughts on it too, so I'll turn it over to him.
Sure. I guess, when the kelp hack happened, and like the first thing I did the first week is I called a bunch of institutions, right? Because I was fearing like, is this like the, Lehman Brothers moment for DeFi? Is this like an FTX moment for DeFi, etc.? And, when FTX happened, it really killed the trust in the ecosystem in a very bad way. And it slowed down the industry by like 2 or 3 years, in my opinion.
Agreed.
And so I called like maybe 10 institutions, like in general. Uh, and I asked them, how they felt about it, etc. And like the first pleasant surprise that I had was that people understand the difference. And that was actually the first point that Amy made, is the difference between the technology and the management, right? Like in
Mm.
DeFi, historically, the first DeFi protocols were fully managed. Like you could think of them as like decentralized brokers. You had token holders voting risk parameters, etc. But over time, the industry has matured and understood that DeFi is infrastructure. DeFi is a piece of code built by computer scientists that is then operated by finance people. But this distinction is critical to understand, because you have two types of risk that people need to understand. Is that you have like the piece of code risk, which is like, the smart contract and the, financial infrastructure itself. And then you have the people operating those pieces of code that, are going to do some risk management, are going to have to do some OPSEC, et cetera, et cetera. And the reality is that DeFi has proven its value as a very strong potential for the technology side of things. But, what we're saying on this first quarter is that the finance piece is probably not best operated by crypto natives, right? And maybe this is actually, and this was the key takeaway from the 10 calls I had, is like, this is actually an opportunity for TradFi to come in with like, 30 years of like finance and asset management, and actually do the proper OPSEC, do the proper risk assessment, do the proper quantitative, like, analysis to be able to like, manage assets in a way that is, confident, as opposed to like a very crypto native, like DAO type of process that, frankly does not make much sense from first principles, right? And so I think that the key takeaway is that one has to understand that DeFi, like the promise of an open financial system that is composable, is just way too big to be, put at risk by a single hack. It's like, it's impossible. It's just like the future of finance is obviously on chain. It's obviously open, because this is what's create the most amount of value for everybody, right? Now, the question is like, who's going to operate those rails? And I think the key takeaway from this first quarter is that it's not going to be the crypto natives operating them. It's going to be either crypto natives that grow up into institutional mode, or institutions that come on chain to operate the services.
Have you changed anything regarding Morpho following these hacks? Like, for example, curator vetting process, or have you tightened up your security? Because you said yourself, like it made you call 10 institutions right after it to really see how they are taking it.
So, the way Morpho works is that we're fully into the infrastructure paradigm. I'm not a finance person. I'm a computer scientist, right? So I in practice, I know how this stuff works, but like the company is not built to do like as asset management, right? We externalize the risk management piece to like a permissionless set of asset, non-custodial asset managers or asset curators. But we don't vet curators, we don't control who can deploy like, a vault or a market on Morpho. Which for us, like, when and so the platform is entirely, isolated and modular. So when something like kelp happens, like someone like Coinbase that is building on Morpho, they don't even blink. Like they know they're not exposed because they have full control over what's happening. Like they don't trust us to do the asset management, right? They work with like, specific providers that, they rely on to like build like the specific isolated risk profile, right? And so that's like the first thing to have in mind is like we, on Morpho you have 2,000 now vaults, different vaults. Like maybe 500 of them are like, probably around like at least $100K of value. And they all have very different risk profiles. Like some of them do the most borrowing, like repo, treasury bills as collateral to borrow USDC or Bitcoin to borrow as USDC. But you also have the craziest, like most risky things that you could ever imagine, like meme coin leverage or things like this, right? And it's not, we don't have an opinion about this, and we should not have an opinion about, what the market should underwrite. And so as a result, our role in such situation is not to say, hey, we're going to constrain the market and we're going to say, you can't underwrite this type of stuff or this type of stuff, because at the end of the day, we want to underwrite 8 billion people. And I don't want to be the player that says, oh, this person does not, cannot be, you can't underwrite that person or you can underwrite this person. What I want is like provide a stack that is sufficiently like modular and flexible for people to be able to cater to the specific compliance and risk profile that they need to. So that's one. And the second one is I need to provide sufficient tools and visibility for the end distributor, the end user, to be able to make conscious choice about how they approach, the Morpho lending stack, right? And I think this is like our role and how we see our role. And so we're obviously doubling down on this and, helping the users get more visibility. Like, for example, we're hosting Vault Summit with like the S&P Global team as co-hosts. Like they also understand those problems very well. It's like DeFi needs more visibility and more, a better understanding of the risk and those kind of things. So this is typically the type of issues that we focus on ourselves.
Yeah, that kind of.
Can I maybe add to that, because I think Paul brings up a good point that I think sometimes gets confused on the traditional finance side, where Paul's talking about providing that infrastructure. This is one thing that is it's a different dynamic for some areas of finance where it's a technology, there's software that is provided to us and we use, but we still own the risk. Like we still have to manage the risk, we still have to own the risk, we still have to determine what the guidelines are. And I think right now there's this battle around, Morpho is going to come, and I'm not trying to say specific, but this DeFi generally is going to come and take our business away. But it's not really the right way to look at it, because ultimately there's like a partnership here in terms of using the infrastructure. And then, we still have a significant platform for distribution that we can leverage. We have a significant pool of clients that have all different risk profiles that we can create products for and provide them more customization, different products than maybe we had the technology to do in the past, because it just wasn't scalable in the same way. So there's a lot of interesting things to consider here for the future. And some of it will just require time to move on a little bit. So even when we, and I was part of our asset management business for over 25 years, when we launched new products or when we went into a new market, a lot of times, even if we had incredible performance in year 1 and year 2 and year 3, they wanted to see a track record that was consistent and had no fail and would be able to work through the cycles. So I think we're kind of in that right now, where we just need time to pass and continue to put good numbers on the board and show the value of what we can deliver through the technology partnership.
Collaboration rather than competition
Yeah.
between traditional asset managers and DeFi. That feeds quite nicely into the next question. I want to ask you, Amy. So when you assess on-chain lending and borrowing protocol, how does this due diligence process look like? Can you compare it to something in TradFi, for example? Is it something similar?
I mean, there's things that are similar to TradFi. So I had run our global emerging market business, and we had built out new markets that were, first equity markets to access for foreign investors. We created new products that had significant risks or assumed risks around them that we had to educate clients on and manage overall. So there's a lot of parallels in doing that. I think on the DeFi side, because of that technology infrastructure, it's just something because if you think about it, no matter what market you went into globally, however risky, most of the time the infrastructure we were using was the same. Basically, the ledger, the central ledger technology, the qualified custodians, the counterparties that we used in the different markets. It was a pretty similar infrastructure, with some variation in that. But mostly technology was not a big part of the due diligence and assessment in a lot of that. And and this is a new world that does require some different risk assessments and governance and processes internally that we need to set up. So I think that's where we're going through that and making sure that we understand just how to set up that new operating model so we can feel comfortable and also make, all of our teams feel comfortable if it's our compliance team, our cybersecurity team, our non-financial risk team, we need to give them a high level of confidence that there's going to be no fail here for our clients, because ultimately that's what our clients expect us to deliver. So, that process is reasonably the same, but there are some differences. The stuff is just getting more sophisticated, and we have, layers of technology that are far more advanced than we've used in the past.
Great. And I have rolling questions in the audience right now, and they are very good. So, Etty ask you, Amy, so how does Morgan Stanley ensure there are no counterparty risk on funds being, I can't really pronounce this word, with terrorist and sanctioned organizations? Or I guess they're coming from how to
Yeah.
ensure that there is no counterparty
Yeah,
risk.
and well, well,
Sorry.
well, well. Let's be clear. We're not live with any when DeFi lending now. I mean, we've been exploring a lot of this and understanding. I think one of the areas that we're most interested in, and I'll get to the question specifically on AML KYC, but one of the areas we're most interested in is using real world assets that we will tokenize going forward and can be used as collateral and potentially create new lending models that don't currently exist even in the traditional world. Like, that's most interesting. I think the thing is, if you're just creating a product that clients can get access to in the traditional markets, and it's a little more painful and harder to understand, that's not the value add that we need to deliver. We need to deliver unique products that we can't deliver in the old world. And so that's one of the areas that I think we're most focused on right now in terms of exploring this. AML KYC, look, that's a huge, discussion and debate that we keep focusing on. And I'm sure Paul has, things that he can talk about on this too. Is it a whitelist? Do we start with more of a walled garden approach so we can get comfortable with just the overall operating model, and then we can over time, when we have more tools to expand and control some of those things we need to control, we can feel comfortable doing that. But look, that question exactly is what makes a lot of people nervous about this space, because in true DeFi, there is that permissionless aspect of it. Coming from the world, that's super interesting to me because there's a lot of value that's been added to countries around the world where people haven't had access to traditional financial uh, services and tools, or potentially governments that restricted populations from even getting access to that. So, that it's an interesting dynamic, but ultimately, AML KYC is a big part of our business, and we do have to figure out how to manage that.
Yeah, I guess maybe if I can add on the DeFi perspective on this, I think for a long time people have been confusing like permissionlessness of Ethereum and DeFi with free for all, kind of, where
Right.
basically, in the Morpho stack, we provide you a permissionless stack that lets you express what you want, including if you don't want people to commingle your funds with you, you can express that, right? And you won't be matched with those people, right? And I think this is true permissionlessness, not for users, but for builders to actually express their full intent, right? And locally comply with whatever rules they're constrained to, not even necessarily regulatory. It could be, credit. It could be like pretty much any arbitrary condition that people want want to enforce on who they want to match with, right? And who they want to connect with. And I think this is like a purely computer science, like modularity, problem, which is how do we provide like programmable compliance for people to be able to enforce the rules that they want, to be able to meet only and connect only with the counterparties that they are comfortable with, right? So what does that mean in practice? It's mostly two things. It's mostly blacklisting and whitelisting. And so in the Morpho protocol, there is like what we call gates, basically, or access gates, where you can basically configure a market or a vault to only be accessible according to certain arbitrary condition, right? So that's for the whitelist, and then the blacklist, you can actually blacklist users according to arbitrary conditions, right? And that can include no one if you want to make like a fully permissionless, in the sense like it's free for anyone to join and connect. But you could also say, hey, I only want to trade with Aleksandar or Amy on this pool, right? For example. And so I think for me, the challenge is like, how do we enable that configurability, that modularity? But at the same time, we should not. We should be conscious that one of the biggest upside of being in an open system is connectivity. It's liquidity, right? So you have to be thoughtful about how you enforce those gates. Can you actually make an understandable language for KYC and gating in such a way that people can compare KYCs with one another and make markets as fungible as possible? And maybe there is a world in which you can pass 20 different KYCs to maximize your connectivity. And it's actually much more efficient and much more, automatically recognized by matching engines, et cetera, et cetera. And I think this is truly the future. The future of finance is not like we have a single pool that aggregates the entirety of the capital in the world. That does not make any sense. The future is letting you express your preference as much as possible, including excluding people, and then having a matching engine that is sufficiently smart to be able to map the intents of everybody in a way that connects liquidity that was not possible before. And I think this is really the core takeaway from like permissioning in DeFi and open finance.
No, I'll just reiterate, on that point on liquidity, that was the thing that pained me the most in the last 10 years of even running my emerging market business, is the local liquidity continued to diminish in many of the markets, because even as you talk to startup founders, where did they want to list their company when they went public? They wanted to go to NASDAQ in the US and list their company there, rather in their local markets. I wanted it in their local markets because I was desperate for more liquidity to be able to put capital to work in that local market. They wanted access to the larger pool of capital that existed in NASDAQ. And to exactly to Paul's point, like that's what we need to deliver. Like we can't be restricting it. There is an opportunity there to open it up and be able to do that. I think it's one of the things that I worry about with some of the regulation, especially if we have super fragmented regulation across different jurisdictions, because the ultimate thing is like to bring that liquidity together. And if we have to try to navigate that fragmented regulation, yeah, we have a lot of code to build. I don't know how we're going to get around it, but like it's not going to make it easy to navigate.
Yeah, I very much agree with that. And if I can throw a startup idea for anyone in the audience, is actually formalizing compliance and make it comparable to one another in such a way that people can effectively, we can defragment liquidity, even though we can impose our constraints. To me, it's like such a huge prize. And I haven't thought too much about it, but that feels like such a major unlock for the financial system. If we're able to delegate KYC efficiency or compare, be able to say this KYC is strictly stronger than this other KYC, et cetera, would truly, truly defragment liquidity a lot and create much more efficiency in capital markets in general.
Yeah, we have unified liquidity layer, but let's work on unified regulatory layer or compliance layer, call it like that. But easier said than done. I mean, it's just a very long-term battle, in my opinion. Amy, I have a question for you from Ramin. He said, any thoughts on how and if emerging markets equity and debt will benefit from tokenized RW?
If emerging markets will?
Emerging market equities and debt.
I think there's an opportunity for many of those markets to take advantage of it. They've been on the forefront, especially if you think about Asia. some of the markets in the Middle East, they have embraced the technology. It's the classic example of they didn't have fixed line phones. They went straight to mobile. It's the same thing we're seeing with the financial system. A lot of these markets have basically just jumped over traditional finance and went straight to fintech, online banking, embedded finance. And so you already have that momentum. You have significant populations, and you can definitely tap in, to that momentum. I think it if you just look at if you look at something like Tether, I mean, how did Tether get as large as it did? I mean, that's happened pretty fast. Like in the last
Yeah.
5 years, it's happened because it's taken liquidity and users from all over the world, all over the emerging markets, and it's given them a tool to get. I mean, all of us, you run into these people in the developed world that constantly are telling you, I don't understand why no one would ever use this. Why would you ever like take capital where you're not even getting yield on it? The reason why they're doing it is because they don't have any other options.
Mm.
Or it's the best tool for them to use for whatever they're trying to take advantage of. And there's also, some trading capabilities that you can leverage that for. But I think if you just look at some of these models, the future and advanced state of this could be very interesting for the emerging markets.
Hope this answers your question, Ramin. I want to circle back to Paul and the DeFi composability feature. We all know it's a feature, but for example, in KelpsDAO exploit more recently, the contagion remains quite a bit problem in DeFi. So how do you think this systemic risk can be solved and mitigated going into the future when the similar hacks happen?
Yeah. So as I mentioned at the beginning, is like both a superpower and a curse, like at the same time. Like I mean, I really like to think about crypto and blockchain as like it's all about openness and everything that comes with it, right? And so when the system is super open, right, and composable and everything, it is, anybody that has done a little bit of economy knows that long term it's like more like economically efficient for everybody. But it's also operates in like, in an environment that is much more brutal, notably in terms of hacks, but not just hacks, but just in general, like just the ecosystem, the crypto ecosystem is extremely brutal. And so what happens is you're gonna have entire systems that are gonna break because of like one tiny dependency, and hopefully the ecosystem learns from this. We compound on the learning. One of the key factors of being open is that you have very interesting compounding effects, right? Open source is one of them. Like the more code that survives the test of time, that is open source and that is reusable, is a strictly net positive for the humanity in general, like literally. And so as we have more pieces of code that, survive the test of time that we can assemble together, we're able to, have chains of codes that are, can actually be interesting financial primitives that are actually safe. But unfortunately, in order to get there, you have to go through those like cycles that Amy was describing, where a lot of hacks and loss can happen, especially for the long tail or like the less secure or the less sort of like the most mismanaged side of the chain. So again, I think the promise of like having a composable, open like financial system, a global financial system is too big to fail. Like this will happen for sure. It's like everything is incentive aligned for this to happen eventually. It's just the path to get there is going to be tough. And yes, maybe we need some guardrails initially. Maybe we need to take more time to develop those pieces of code. Maybe we need to use much more formal verification, etc. I think just in general, the crypto industry also needs more talent, more technical talent. And I'm thankful that, the TradFi and the fintech space are bringing much more talent than crypto used to have. I think is probably one of the biggest problems I've seen in crypto is that the talent density is actually not that strong compared to other industries in tech. Notably because of the speculation aspect that tends to repel technical talent quite a bit. And I think as we sort of like aggregate this knowledge and make it public in such a way that we can compound, then yes, we will be able to have more and more composable systems that are actually safe and that produce much more economic value. And as a result, will be the most adopted systems. So I guess TLDR is that yes, eventually for sure we'll have, composable financial systems. It's just the path to get there might be a bit slower than what we thought it would be.
Yeah.
And maybe just to add to that, I think the other thing too is like there is definitely a generational aspect of this that I still don't think we totally know how it's going to play out here. You always talk about this like wealth trans or this
Mm,
wealth transition that's going to happen from the last generation to the younger generation. We have different patterns in terms of how they think about investments. I mean, look at prediction markets, even just over the last like 2 years. It's totally crazy how it's just blown
I
up,
agree.
and we've just have this new thing that didn't even exist, and I think when you think about the younger generation, there's definitely more interest there in being involved in trading markets. I think the other aspect that I think about a lot, and I've always followed from my old role, like the gaming side of the business. I mean, even if I talk to my kids, and I was talking to a colleague about it yesterday, you have a whole generation. I mean, my son will say, like, how do you put your picture online? You don't use your real picture. You don't use your real name. Like, that's
Yeah.
just like you interact with significant platforms and engage with what's a very significant part of their life without even potentially using their real name or their real photo. I mean, people make fun of the crypto space for, that existing as part of the culture of the crypto space, but there's something that's very real about the generation, and I've been surprised to see even how some of the younger generation is so resistant to AI taking
Mm,
their data, that I still think there's lots of questions around what the behavioral change that comes through from that next generation in terms how they engage with investing in money. And I don't think I hate to say, like the old, kind of the old guard, there's no way that we know how that's going to happen unless you're really, really paying attention to some of those behavioral changes.
yeah, I agree. I even noticed it between me and my parents. Like they are very, very, let's say, careful for every spending that they make and investment that they make, and they don't like anything that's not tangible. And I have very hard time explaining to them what the Bitcoin is for more DeFi. Like I just gave up a long, long time ago. But it's a very interesting point, Amy, and I think you're absolutely right. Uh, I wanna circle back before we wrap up with the forward-looking view about the AI and hacks. I have a very interesting question from Maxence that asked Paul to explain us how Morpho Midnight is building to be resistant against hacks.
Yeah, it's a good question. I mean, it's like super long and painful. Like,
Yeah.
is the short answer. So Morpho Midnight, for those who are not familiar, is like the next generation of the Morpho protocol that we've been building for like 2 years and a half now. And I mean, 2 years and a half, like for a startup as young as Morpho, is like insane. Like product development, usually is like, you ship as fast as possible. You do an iteration the next day, and then Cloud Code, like, builds your next iteration as fast as possible. It's like the general recommendation for startups to find product market fit, etc. I think building a DeFi protocol is like the exact opposite of that, because you're in the business of like, trust and like financial infrastructure that needs to be trusted. And so you can't actually like do those like iterations, because otherwise you're just going to get hacked, right? And so the process is pretty unique and intense, because it's mostly, for those 2.5 years, I'd say it's at least a year and a half of pure design, purely like thinking about like aggregating the needs, because you need to build a mental model about like what DeFi is going to be for the next 5 years. Instead of like going to market with a product and getting some feedback, you actually have to construct a mental model of what the market is going to look like and build a product that fits that model, right? Instead of truly going to market. And so the design phase is extremely painful and long, I have to say. At Morpho, the way it works is like, we have like 3 calls of like 2-3 hours per week where we just like challenge every single assumption about like what we think is the good design for obligations, for example. So Midnight is a fixed rate, fixed term protocol. Think of it as like, creating obligations and trading obligations on a platform. Is very close to what you could see in TradFi, actually, except that it's on chain and it's permissionless and configurable. And then the security process, when you have a good design, it actually goes a very long way into like having the correct abstractions for the code, right? But once you actually code the thing, usually what you do is you do the formal verification specification before. So you actually come up with the specs of the code even before you code the thing. Then in practice they sort of like happen in tandem. And even though the piece of code is less than 1,000 lines of code, it probably takes like at least 3 to 4 months minimum to like get the first version that is going to go through the first rounds of audits. And then once you do that, you have multiple rounds of audits. So we work with like every single like audit firm of smart contract in the world. Like Morpho, I think, was like the most audited smart contract per line of code in the entire EVM ecosystem. And so that's like the kind of things that you have to go through. That's very long. We also do audit competitions with like numerous white hat hackers that are able to like go through it. And then you have bug bounties, you have stage releases. There's like a very lengthy process overall that I wish frankly was much shorter. But this is what you need to be able to like have something that is trusted and that is actually safe. But sometimes it's also tempting to shortcut some of those steps, right? Because it's a competitive space. I mean, it used to be a competitive space at least, and so sometimes you may want to take shortcuts, but historically, every team that we've seen taking shortcuts has been punished pretty heavily.
Has been punished.
Right? So yeah. So yeah, I don't know if that answers the question of like how we secure the thing, but I guess that's how we approach it internally.
Hope it does. I know the answer is too complicated to be explained in 2 minutes. So yeah, thank you for this reason. Lastly, from my side, and to wrap up with the forward-looking view. So Amy, I'm very interested in knowing what would it take for multi-trillion asset manager investment bank to treat DeFi and yield products like fixed income. What would finally unlock this capital flood into DeFi?
There needs to be something, again, that doesn't exist from the exposure they already have, right? So if they have a product that fits into their account now, it looks like all of their other assets, it's easy to manage, they're getting a yield that they're comfortable with, whatever that is. I mean, maybe some people are, and again, this goes back to that generational aspect. If you are just looking to protect your wealth and have some like strong yield on that, they may be comfortable with lower risk and maybe mid single digit yield. So I think the thing that you need to unlock is twofold. One, some of the usability that they can't have now with traditional assets. So maybe going back to the point on liquidity, on collateral management, those are really important. And then of course, like higher yielding products, because you do have some people that will just, sort by the highest yielding product and click, right? So we do have a fiduciary responsibility in much of our business and the assets we manage, unless it's self-directed. The self-directed individuals can come on the platforms and select whatever investments they want. But when it comes to fiduciary responsibility, you have to basically navigate around that risk return profile and also that benefit. So basically what we need that benefit of the DeFi products to be higher than what we deliver in the traditional space.
I see.
And that's possible. Like we can definitely create that. It's just going to take us time to both like prove to the market that we can do it, the value that comes with that, and then of course that it's consistent over time, and try to keep any of this like noise around hacks or anything else to a minimum. And even just to like reinforce that on the hacks, it's interesting. Now we had a couple big ones, just more recently, but even so, it's like how many people knew sometimes you have these hacks and you've never even heard of the protocol, or like very few people, even people that we know in the digital asset space. It's like, I've never heard of that until it made the headline. So we shouldn't have some of those smaller companies that don't take security as seriously or strategy as seriously, like ruin it for all of us. So we have to, I think, make sure that we're out there educating the new participants too, in terms of like the differentiation that does exist in the marketplace.
Yeah. Paul, I'll let you finish.
Yeah, I guess I wanted to add on that. I think the point of like building products that are stronger than TradFi products is spot on, and it's very hard. To be frank, because as much as this industry has been criticizing TradFi infrastructure for the last 15 years, TradFi infrastructure works extremely well, has extremely deep liquidity, and has very thin spreads in many cases, right? And so So getting to that point where we can prove that some products can be stronger in on-chain than and in TradFi is hard, but we do have some certain proof points and actually a very strong path to get there. And you have to think from first principles, like what is the blockchain bringing to the table that TradFi infrastructure does not have? And I think the answer is, again, comes back to the openness, right? And openness is multiple things. Openness is it's easy to integrate, right? So if it's easy to integrate, you're going to get distribution. If you're going to get distribution, you're going to have unique order flow, like coming from the fintechs, for example, that are all moving on chain. Another advantage is that if it's open, well, people is going to be much more competitive, right? Like we see this in lending, like, the cost of capital that you can provide on chain is actually extremely competitive because asset managers can actually like compete to provide like the best possible rates to the users instead of like having the pricing controlled by like different intermediaries. And those are like unique, value proposition that it's like more of a theoretical set of things, but started to become concrete for end users. I'd say for the first time 12 months ago, the first time ever DeFi was able to provide a financial product that was strictly better than CeFi was when Coinbase integrated crypto back loans on chain as opposed to centralized, right? That was the first time ever. Before we had higher yield and stuff, but like it's not a solution to like take enormous amount of risk to have higher yield than TradFi. This has been like what the space has come up with as a solution for the last like few years. That does not work. And that's, obviously going to cause a much damage and reputation risk and everything. What Coinbase did is they used to have a centralized lending service, right? And when we came to them and explained that, they could do this on chain, the main argument was if you move on chain, you're going to have global access to capital. You're going to have lenders that are going to come not just from the Coinbase ecosystem, but also from Kraken, from Binance, from your competitors that are going to compete to provide the best yield to their users. And so when you're borrowing from Coinbase, right, on base, you're effectively, borrowing this money maybe from the Kraken Earn product that is generating yield from the users. And that's the unique selling point, is that now you have like very competitive cost of capital that allows Coinbase to offer this product at a yield that is just very close to SOFR, right? The rate for borrowers to come into the Morpho market on Bitcoin back loans is around SOFR, right? It's slightly above. And this is extraordinary because the centralized version of that product, right, existed before, but it was SOFR plus 300, SOFR plus 400, right? So anyway, that was to me like the first proof point for us as an industry. And we need to build on that. We need to replicate that and extend to not just Bitcoin back loans, but, all the types of asset back loans, securities back loans, like, alternative asset back loans, etc., and benefit from this cost of capital that is extremely competitive, that is extremely low. Benefit from this distribution that is coming on chain and all the fintechs bringing in their deposits and their stablecoins in order to create competitive products. To me, that's the path. And it's going to take long. But that's where we have to go to.
Perfect. So infrastructure is there, product is there, risk frameworks are there, and they are constantly developing. I would say the major pain points are compliance and lack of understanding. It's what I get from this discussion. And I want to thank you so much for joining me today. I'm enjoying quite a lot, learning quite a lot. You open my perspectives, especially on the emerging market. And Paul, sorry, I'm not a technical guy, but I wish to understand you more so we can have a meaningful conversation on the techniques background and engine. But you were great, and thank you all in the audience for participation, and we'll see you next time. Bye bye.
Thanks for having us.
Thank you.
Bye.